Hello, everyone. Distinguished guests, dear colleagues, ladies and gentlemen, it is a pleasure to address you on a subject that is both operationally concrete and institutionally fundamental: cash in times of crisis. My central argument for today is simple. Cash should not be understood as a residual instrument of the pre-digital economy. It should be understood as public contingency infrastructure. It is money citizens can hold directly. It settles immediately. It does not require electricity, telecommunications, or third-party authorization at the point of payment. And it translates institutional trust into a physical object. In normal times, cash may be measured by transactions share. In crisis, it is measured by whether it remains available, accessible, accepted, and trusted. This broader perspective matters because cash has a dual role in the payment ecosystem. In ordinary conditions, it functions primarily as a payment instrument. In uncertain conditions, however, it also becomes a confidence instrument. A decline in transactional cash does not automatically imply a decline in its public value. The European Central Bank study on the payment attitudes of consumers in the euro area shows that cash remained the most frequently used instrument at the point of sale by number of transactions in 2024, accounting for 52% of such payments. At the same time, 62% of euro area consumers considered it important or very important to have cash as a payment option. This is a policy signal. Citizens may use digital payments more frequently in daily life while still valuing cash as an option that protects autonomy, privacy, inclusion, and resilience. It is also consistent with the so-called paradox of banknotes. Demand for banknotes can remain robust or even rise, while cash use for everyday transactions declines. The Eurosystem cash strategy states that cash should remain widely available, accessible, and accepted as both a means of payment and a store of value. In a diversified payments ecosystem, cash is not the opponent of digital payments. It is their institutional complement, a source of redundancy, choice, and trust in public money. This complementary role becomes particularly visible in periods of uncertainty. Across different crises, the empirical pattern is remarkably consistent. When uncertainty rises, demand for physical currency also increases, even if the underlying motivations and denomination structure differ. Cash contributes to stability because it provides immediate settlement, legal tender functionality, independence from digital infrastructure, and very important, broad public recognition. The nature of the shock matters. When a crisis affects electronic payments through cyber attacks, power outages, telecommunication failures, or natural disasters, demand may be directed mainly towards lower denominations, which are essential for day-to-day transactions. When the crisis is driven by confidence concerns, financial instability, political uncertainty, geopolitical tensions, or fears about the banking system, demand tends to shift towards higher denomination, reflecting the role of cash as a liquid and immediately accessible store of value. The ECB's analysis after Russia's invasion of Ukraine is particularly relevant. Euro banknote gross outflows to Central, Eastern, and Southeastern European countries more than trebled 3 times in 2022 compared with 2021, and several euro area countries closer to the conflict recorded exceptionally high demand relative to historical norms. This was not merely a liquidity event. It was a trust event shaped by proximity, perception, and memory. Comparative analysis of the COVID-19 pandemic, Russia's invasion of Ukraine, and the Iberian blackout of 2025 reaches the same conclusion: tangibility, resilience, offline functionality, and wide acceptance become particularly valuable in crisis conditions. Romania's operational experience reflects the same dynamic. During the COVID-19 pandemic, the value of cash in circulation increased by 19% in 2020. Central bank cash payments to credit institutions and state treasury increased by 22% compared with the average of the previous 5 years, while cash collected decreased by 18.9%. These figures show that a crisis changes not only the level of cash demand, but also the direction and stability of cash flows. In normal times, the cash cycle has a degree of circularity: withdrawals, retail circulation, deposits, sorting, recirculation, and reissuance. In crisis, that circularity may weaken. Outflows rise, inflows fall, and the central bank must supply the system while private recirculation becomes less predictable. The outbreak of the war in Ukraine generated another shock. Between 1st of March and 14th of March 2022, cash withdrawals from the central bank totaled 5.1 billion lei, which at that moment accounted for 5% of the total currency in circulation, while cash lodgements amounted to only 1.2 billion a quarter. Net issuance reached 3.9 billion lei, approximately 800 million euro, almost 4 times higher than the average for the previous 5 years. On a single day, 8 March 2022, cash requests peaked 1 billion lei, 1% of the currency in circulation. Over an equivalent period of 8 working days, cash in circulation increased by 4.8% at the onset of the pandemic and by 3.4% at the onset of the war in Ukraine. Yet the post-shock dynamics differed. After the outbreak of war, banknotes returned more rapidly to the central bank than during the pandemic. A health crisis, a war-related confidence shock, a cyber incident, and the blackout may all increase the need for cash, but through different channels and different durations. The operational conclusion is clear. Central banks require scenario-based cash planning, not a single crisis template. This also highlights a broader point. Cash provides an important resilience service for society. Like insurance, it is often undervalued before the adverse event and fully appreciated only after it. In normal times, maintaining stocks, distribution networks, ATM access, transport capacity, operational expertise may seem costly or easy to overlook while digital payments function smoothly. During disruptions, however, this becomes essential systemic assets that support continuity, confidence, and public trust. Cash also has the characteristics of a public good. It is non-excludable because individuals who normally rely on cards, mobile payments, or online transfers cannot be excluded from using cash when a crisis occurs. It is also non-rival because one person's ability to rely on cash does not reduce the protection available to others. On the contrary, the wider the availability and usability of cash, the stronger the resilience of the payment system as a whole. This provides a strong theoretical justification for the involvement of central banks and public authorities in safeguarding a functioning cash cycle. Cash also supports financial inclusion, budgeting, lawful privacy, and participation without a bank account or a smartphone. These functions are part of a broader social role of public money. A mature cash resilience framework can be organized around the 4 A's of cash infrastructure: access, acceptance, availability, and affordability. Access means that citizens and businesses can obtain cash within a reasonable distance, at reasonable cost, and under stress. Austria offers a practical example. The Österreichische Nationalbank is supporting the deployment of up to 120 ATMs, mainly in rural municipalities, lacking both an ATM and a bank branch. Acceptance means that cash can actually be used. In crisis, citizens need confidence that cash will be accepted, at least for essential goods and services. Slovakia, Hungary, and Slovenia have elevated the right to use or pay in cash to constitutional level, while Switzerland has constitutionally protected the supply of cash and the preservation of the national currency. At EU level, the Commission proposal on the legal tender of euro banknotes and coins clarifies mandatory acceptance, acceptance at full face value, and the power to discharge payment obligations. Availability refers to aggregate stocks, denomination structure, fitness quality, and geographical positioning. And affordability means that cash use should not become excessively costly or inconvenient. Otherwise, its universal function is gradually weakened. The cash cycle must therefore be treated as a critical network. Central bank vaults, regional branches, commercial banks, cash in transit companies, ATM operators, retailer, post offices, security providers, telecommunications providers, public authorities, and households. If one node fails, the system must be able to reroute flows quickly enough to preserve public confidence. This requires detailed mapping of dependencies, escalation protocols, and tested contingency arrangements. Several jurisdictions already reflect this approach. The Bank of England has supervisory responsibilities aimed at ensuring that the UK wholesale cash distribution infrastructure remains effective, resilient, and sustainable. A growing number of European authorities also include cash in household emergency preparedness guidance. Austria, the Netherlands, Finland, Sweden, Norway, Denmark, Germany, Latvia, Estonia advise citizens to keep modest amounts of cash, often in small denominations, to cope with payment disruptions, cyber incidents, and power outages. This is not a retreat from modern payments. It is an attempt to make modern payments, and I quote, survivable. Efficiency without fallback capacity can create fragility. In this context, the role of central banks extends well beyond the issuance of banknotes. We are not only producers and distributors of cash, but also guardians of public confidence in money across normality, stress, and emergency. Reserve policy must be built on explicit stress scenarios, including rare but high-impact surges, denomination shifts, and regional needs. Crisis planning must include stress testing of the cash cycle, power outages, cyber attacks, geopolitical escalation, fuel shortages, pandemic restrictions, natural disaster, and so on. Cooperation with commercial banks, cash in transit companies, ATM operators, retailers, and public authorities must be formalized before a crisis occurs. In stress conditions, ambiguity consumes time, and time consumes confidence. Communication itself becomes part of the operational response. The public needs confidence that the central bank is prepared, that cash remains available, and that continuity measures are in place. This reflects a broader shift towards preparedness by design. In conclusion, the future of payments should not be framed as a choice between cash and digital innovation. Digital payments will continue to expand, and new forms of public money may emerge. At the same time, cash should continue to provide universality, immediacy, privacy, inclusion, and offline resilience. In crisis, cash performs a function larger than payment. It transforms institutional trust into physical continuity. It gives citizens direct access to central bank money and supports exchange when infrastructure is impaired. The public may not ask how the cash cycle works, but it judges whether it works. And when confidence is under pressure, continuity is not a technical detail. It is the foundation of trust. The strategic question is not whether cash will remain dominant in everyday transactions. In many economies, it will probably not. The question is whether cash will remain credible, accessible, and operational when it matters most. On that question, central banks cannot be passive observers. We must be active designers of resilience. Thank you.